Most traders think they need a better strategy, a cleaner entry, a sharper signal. So they spend months, sometimes years, testing setups, switching indicators, chasing the one pattern that finally makes everything click. That search never ends. Not because the right strategy doesn't exist, but because a strategy was never what was missing. What's missing is everything around it. The exit rules decided before the trade opens. The position size calculated before confidence inflates it. The scheduled hours that keep you off the platform when your edge doesn't exist. The journal that shows you, in writing, exactly where you break your own rules and why. The psychological framework that makes a loss feel like nothing because you already expected it. That's a complete trading system. 6 parts. Most traders have one. In the next 30 minutes, I'm going to show you all 6, what each one actually does, and why the 5 you're probably ignoring are the ones determining your results right now. Welcome to Trader's Bible, the quiet room for market mastery. Before we get into this, I want to mention something quickly. Everything we cover in this video is pulled directly from a full written trading system guide that we've put together, and it's available at a giveaway price in the description below. If you want something you can actually sit with, annotate, and build your own system from, it's down there. Now let's get into it. The first thing most traders build is their entry. And that makes sense. The entry feels like the trade. It's the moment of commitment, the point where the idea becomes real. So naturally, that's where the attention goes. Find the right setup. Find the right signal. Find the right conditions. And if the trade doesn't work, the assumption is that the entry was wrong. So you go and find a better one. But here's what's actually happening in most of those cases. The entry isn't wrong, it's vague. And vague is worse than wrong, because wrong you can fix. Vague you can always convince yourself you got right. Think about how most traders actually describe their entry criteria when you ask them. They say things like, the trend looks strong, or momentum is building, or the setup looks clean. And they mean it. They genuinely believe they have a rule. But what they actually have is a feeling that they've dressed up in trading language. Strong trend compared to what? Momentum measured how? Clean setup by whose standard? And on which time frame? And confirmed by what? None of those descriptions tell you anything concrete. And that matters enormously, because when you're calm, sitting at your desk before the market opens, running through a checklist in your head, those descriptions feel perfectly reasonable. You know what you mean. But the moment you're inside a live trade, and the price is moving, and your account balance is ticking up and down in real time, the definition of looks strong starts shifting. Suddenly strong looks like enough, and enough becomes whatever you need it to be to justify staying in, or getting in, or adding to the position. That's not a strategy problem. That's a specificity problem. Here's the standard your entry criteria actually needs to meet. Write it down. Hand it to someone who has never seen your charts before. Walk them through the same chart you're looking at, and ask them whether a trade should be placed right now or not. If their answer matches yours, your criteria is specific enough. If it doesn't, it isn't a rule yet. It's still a feeling. And no matter how experienced that feeling gets, it will never give you the consistency a written rule does. The reason specificity feels restrictive is because it is, deliberately. The box your entry criteria creates isn't there to limit your opportunities. It's there to protect you from the ones that don't actually exist. Because your brain, under the pressure of watching a market move, will manufacture reasons to be in a trade. It will pattern match on incomplete setups. It will round up a 60% match to a 100% match because the position looks exciting. Specificity is the only thing that stops that from happening. The box is the edge, not a constraint on it. Now, let's say your entry criteria is solid, specific, written, non-negotiable. You've identified a setup that meets every condition. You place the trade. Here's where most traders immediately lose the advantage they just built. They think about the exit later. They enter with a clear plan and no defined ending. And that gap, that space between I'm in and I know exactly when I'm getting out, is where most of the money gets lost. Not to bad entries, to exits that were never decided. Here's the principle most traders get completely backwards. The entry only gives you a shot at being right. The exit is what actually determines whether you make money. You can have a mediocre entry process and excellent exit discipline and be profitable. You cannot have excellent entries and no exit discipline and expect the same result. It doesn't work that way. The money lives in the exit. Your exit strategy has two sides and both need to exist before the trade is ever opened. Not while it's running, not after you see which way it's going. Before you click the button. The first side is where you get out when you're wrong. Your stop loss. And this part is simple in principle and brutally difficult in practice. Your stop loss is the point on the chart where the market has proven your trade idea incorrect. Not uncomfortable, not worrying, incorrect. There's a difference. Uncomfortable is price moving against you temporarily within the normal range of movement your setup operates in. Incorrect is price reaching the level that your analysis said it shouldn't reach if the trade idea was valid. When price hits that level, the trade is over. Full stop. That's it. But here's where it goes wrong. And it goes wrong for almost everyone at some point. The trade gets close to the stop, close enough that you can feel it. And your brain starts working against you. It starts generating reasons why this particular trade deserves more room. The idea is still valid. The move just needs more time. This is probably just a stop hunt before the real direction asserts itself. You move the stop just this once, a few pips, a few points, just enough breathing room. And sometimes the trade comes back. Price reverses right there and runs beautifully in your direction. And in that moment, you feel smart. You feel like you read the market. You feel like the rule bending was justified. What actually happened is that you trained yourself to break your rules, and the reward you just received for doing it makes it significantly more likely you'll do it again. That one moment of it working is more dangerous than 10 times of it failing, because it creates a pattern in your behavior that doesn't get corrected until it costs you seriously. Moving stops isn't giving trades room. It's converting a trading decision into a gambling one. Because the logic that defined the trade, the analysis, the setup, the plan, all of it was written based on the stop being where it is. The moment you move it, you're no longer in the trade you planned. You're in a different one, with different risk, no written justification, and zero edge. The second side of your exit strategy is where you get out when you're right. Your take profit, or if you run a trailing approach, the specific rules that govern how you trail. And this side gets broken in the opposite direction. When a trade moves your way, emotions don't go quiet. They get louder. They just change what they're saying. Instead of hold on a bit longer because the trade might come back, now they're saying lock it in before it reverses. And both voices, the one that makes you hold losers and the one that makes you cut winners, are the same problem. They're real-time emotional negotiations overriding a plan that was made with a clear head. The fix is the same as the stop-loss fix. Decide before you enter. Commit fully. Execute without revisiting. Whatever your take-profit logic is, it should be written in the same place as your entry criteria. Visible before the trade opens. Non-negotiable once the trade is live. Decide in advance. Execute exactly. Move on completely. That sequence, repeated consistently, is what profitable trading actually looks like from the inside. Now let's talk about the part that beginners either skip entirely or understand perfectly and still find a way to ignore when it matters most. Risk management. The core rule here is this. You never risk more than a fixed percentage of your account on any single trade. And when I say never, I mean it in the same way a surgeon means never skip sterilization. Not most of the time. Not when the setup is average. Not when the setup is exceptional either. Never. The range most consistently profitable traders work within is 0.5% to 2% per trade. That ceiling doesn't move when the setup looks perfect. It doesn't move when the pattern has triggered correctly the last 7 times. It doesn't move when you feel unusually confident or when you're down for the week and feel like you need to recover it faster. The ceiling doesn't move. That's the entire point of having a ceiling. Here's why this matters at a mathematical level that most beginners don't sit with long enough. Take two traders. Trader A has the system that wins 50% of the time. Average winner equals average loser. Clean, boring, unremarkable. Trader B has a system that wins 80% of the time. Genuinely excellent win rate. Most traders would choose to be Trader B without a second thought. Now give Trader A fixed risk management. 1% per trade, no exceptions. And give Trader B no risk management at all. Variable sizing based on conviction. Run both forward for a year. Trader A builds their account steadily. Drawdowns happen. They're manageable. The math compounds quietly in the background. Trader B looks incredible for the first several months. The win rate is real. The confidence builds. The position sizes start creeping up on the best-looking setups. And then a losing streak arrives, because all systems have them. And when it arrives, the inflated position sizes on the worst possible run of trades do damage that the 80% win rate cannot recover from. Sometimes it ends the account entirely. This is not a theoretical scenario. This plays out in real trading accounts every day. The math is not forgiving, and it doesn't care how good the setup looks. Positioning is where risk management actually lives. Knowing that you risk 1% per trade is the principle. Calculating the exact number of units, contracts, or shares so that if your stop gets hit, you lose exactly 1% and not 1.4% because you eyeballed it. That's the practice. That calculation takes under a minute. It requires knowing your account size, your risk percentage, and the distance in points or pips or ticks between your entry and your stop. The formula is straightforward. The result is non-negotiable. Do it every single trade, without exception, without variance, without rounding up, because the number feels slightly too small. The traders who do this consistently cannot understand why it took them so long to start. The traders who skip it can never quite figure out why their account isn't moving the way they expect. The calculation is 30 seconds of work that changes the entire trajectory of an account over time. Do it every time. At this point in the video, if you're finding this useful, the best thing you can do right now is subscribe, hit the like button, and turn on notifications. Everything on this channel is built around this kind of depth. No noise. No hype. Just the actual mechanics of what makes trading work. Subscribe so you don't miss what's coming. Now, we've covered what to trade, how to exit, and how much to put on it. Here's the part nobody wants to hear about but quietly destroys more accounts than bad entries ever will. When you trade matters as much as what you trade. Every market has sessions. Every session has windows. Specific periods of time where volume is high, spreads are tight, and price moves with intent. These are the conditions your edge was built on. Whether you backtested a system manually or built one through screen time and observation, the patterns you identified were happening during these windows. The liquidity was there. The movement was directional. The setups were clean. Outside those windows, the market is a different environment. Spreads widen. Volume dries up. Price drifts without conviction. Chops sideways. Triggers patterns that immediately fail, and generally behaves in ways that look different enough to trade, but are fundamentally different from the conditions that make your system work. Your edge doesn't travel into those hours with you. It stays where it belongs. The solution is a trading schedule, not a rough idea of when you tend to trade. A written rule, specific start time, specific end time, and a commitment that outside those hours the platform is closed, not minimized. Not sitting in the background while you watch something else and occasionally check it. Closed. Here's the real reason this matters. Think about the worst trades you've placed. The ones that were clearly impulsive in hindsight. The revenge trades after a bad loss. The boredom trades because nothing had triggered for a few hours, and you started getting restless. The this looks interesting trades that had no real connection to your setup, but felt too tempting to ignore. Ask yourself honestly what time most of those happened. Almost all of them happened outside of your best trading hours. You were on the platform with no real purpose, watching price move without a genuine setup in play. And the combination of proximity, attention, and restlessness created the conditions for a bad decision. Not a strategic one, an emotional one. The trading schedule removes those conditions entirely. If the platform is closed, the decision can't be made. The rule doesn't require you to be disciplined in the moment. It removes the moment entirely. That's the difference between rules that depend on your willpower and rules that remove the need for it. Build your schedule into the system. Treat it with the same weight you give your entry criteria, not a preference, a rule. Now we get to the part of the system that most traders know they should do, intend to do, and consistently don't do with any genuine honesty. Journaling. Here's the honest framing for why journaling matters. Your account balance tells you what happened. It does not tell you why. And without the why, you cannot improve. You can accumulate time in the market indefinitely, and time without understanding produces no development. It just produces more of the same. Experienced bad habits are still bad habits. What a journal actually does is create a feedback loop. After every trade, you record not just the result but the process. Every decision, the entry, was it exactly according to your criteria, or did you bend one condition? The stop placement, was it where your rules dictated, or did you compromise? The sizing, did you calculate it or estimate it? The exit, did you follow your plan, or did you negotiate with yourself mid-trade? Did you take a trade outside your defined hours because it looked too good to pass up? Did you skip a valid trade because your last one lost and you weren't feeling confident? Every one of those answers is more important than the profit or loss number beside it. Because the number is the outcome, the answers are the cause. And causes are the only things you can actually change. Here's what consistently honest journaling reveals, and this finding is remarkably universal across traders who actually do it properly. It is almost never the strategy that's the problem. The setup, the signal, the entry criteria, the technical analysis, that part is usually working reasonably well. What the journal exposes is a small number of specific psychological triggers, particular conditions or emotional states that reliably push the trader outside of their rules at exactly the wrong moments. Maybe it's always after 2 consecutive losing trades. The journal shows that trades 3 and 4 in a losing sequence are where the rules start bending, where position sizes drift upward and stop logic gets stretched. Maybe it's on Friday afternoons when the trader starts feeling like the week needs to be recovered before it closes. Maybe it's on setups in one specific asset that the trader has an emotional attachment to, where objectivity quietly disappears. You cannot fix a trigger you cannot see. The journal makes it visible. Review it weekly, every trade, not with the purpose of criticizing yourself or celebrating yourself, with the purpose of understanding yourself. The patterns that show up in 3 or 4 weeks of honest journaling are often things that have been present in a trader's behavior for years without ever being noticed, because the account balance buries the why in the what. The traders who build this habit consistently improve month over month, not because their strategy got better, because they got clearer on exactly where their behavior diverges from their plan and why. That clarity is the improvement. Everything else follows from it. Which brings us to the last part of the system, the one that sits underneath everything else and determines whether any of the other 5 parts actually hold together when it counts. Your psychological framework, and I want to be direct about something before we get into it. This is the part most trading education treats as separate, optional. The soft stuff you address once the hard technical work is done. And that framing is exactly backwards. The psychological framework isn't an addition to the system. It's the foundation it sits on. If this part is unstable, the other 5 parts will fail. Not sometimes, reliably, in the exact moments where the stakes are highest and the pressure is real. Your psychological framework is a set of beliefs about trading that allow you to follow your rules when following them is genuinely difficult, not when it's easy. when it's hard. And there are three specific beliefs that form the core of it. The first is this: a single trade means nothing. Read that again. A single trade means nothing. Your system does not produce results in one trade. It doesn't produce results in 5 or 10 or 20. A system produces results across hundreds of trades over time. The only thing a single trade can tell you is whether you executed your rules correctly. That's all. Nothing else is available from one data point. This means that a losing trade where you followed every rule perfectly, entry criteria fully met, stop in the right place, price position sized correctly, exit executed as planned, is a success. Not a partial success, a complete one. You did exactly what the system required. The result was negative. The process was right. That's a successful execution of a well-built system experiencing its normal statistical variance. And a winning trade where you broke 3 rules, moved your stop, sized up on a feeling, entered outside your criteria is a failure, even if the account number went up, because you rewarded behavior that, if repeated consistently, will eventually and significantly damage your account. The win didn't validate the process. It obscured a dangerous one. This belief is genuinely difficult to hold. Every human instinct points toward results as the measure of correctness. We are wired to use outcomes as feedback. But in trading, the sample size of one trade is statistically meaningless. Outcomes tell you nothing useful at that scale. Process is the only thing worth measuring and adjusting on a trade-by-trade basis. The traders who internalize this, not just intellectually understand it but actually believe it, are the ones who can close a losing trade, log it in the journal, and feel nothing negative. Because they did their job. The market did what markets do. That's the complete story. The second belief is that drawdown is expected, not catastrophic. Every complete system goes through periods of underperformance, weeks where the setups aren't triggering cleanly, months where the win rate is running below its average. These aren't signs of a broken system. They're the normal distribution of results that every honest backtest will show you before you ever go live. The drawdown is already baked into the system. You've already seen it in the data. The only question is whether you recognize it as normal when it arrives in real time, or whether you panic. Beginners without a psychological framework quit during these periods. The losing streak feels like evidence that the system doesn't work. So they stop, look for something new, start the process over. And they stay in a permanent cycle of beginning, because they always leave before the results that required patience actually arrive. The traders with a psychological framework do something different. Before they go live with a system, they calculate the historical drawdown. They understand what a normal losing streak looks like for their specific setup and win rate. So when the losing period comes, and it always comes, they don't experience it as a crisis. They recognize it. They name it. They say, this is the normal drawdown for a system with these characteristics, and they keep executing. Because they understand that the solution is time and continued correct execution, not change. The third belief is the one that separates traders who make it from the ones who don't, and it's the hardest one to genuinely accept. Boredom is the goal. Not a side effect, not a cost, the goal. A complete trading system followed correctly is deeply, consistently boring. There is no adrenaline in entries, no drama in exits, no emotional weight attached to individual results. No excitement, no devastation, no rush, just process. The same rules applied to the same criteria in the same way, over and over, every session, every week, every month. Quiet, repetitive, mechanical execution, and when you get there, when trading genuinely feels boring to you, that's not a sign that something's wrong. That's the clearest possible sign that something is finally right. The market is designed to feel exciting. Price movement creates urgency. Gains create euphoria. Losses create pain. And the combination of those feelings creates traders who confuse emotional engagement with good trading. They feel like they're doing something when they're in a trade and feeling it intensely. But that feeling is not signal. That feeling is noise. And the more you chase it, the further you get from the consistency that actually builds an account. Profitable trading is boring. Not occasionally boring. Structurally, fundamentally, intentionally boring. And the traders who understand that, and who build a system and a psychology that makes peace with it, are the ones who are still trading profitably 5 years from now. The ones chasing excitement are the ones funding them. Here's the full picture. 6 parts. Entry criteria that's specific enough to be testable by a stranger. Exit rules both sides, committed to before the trade opens. Risk management that doesn't move regardless of how good the setup looks. A trading schedule that removes the conditions for impulsive decisions entirely. A journaling process that turns experience into actual self-knowledge. And a psychological framework that makes all 5 of those things hold together when the pressure is real. Most traders have one of these, maybe 2. They spend years wondering why consistency stays out of reach, cycling through strategies, tweaking indicators, trying different markets, never finding the answer, because they're looking in the wrong place. The strategy isn't the problem. It was never the strategy. It's the system around it, the complete one, all 6 parts. In the next video, we're going to take each of these parts and show you exactly how to build them from scratch for your own trading. Not the theory, the actual construction. What the entry criteria document looks like, how the position sizing calculation works, what a proper journaling template captures, how to do it properly step by step. If you want to get ahead of that, the full written system guide is in the description. It's everything in one place at a price that makes it a complete no-brainer. But the video's coming either way. Make sure you're subscribed so you don't miss it.